Back with trading calls right here on ET now. Just minutes left to go before we kickstart the pre-open rates for today. So let's bring in Sandeep Pagle and chat about his trading calls. Sandeep, what is it that you've identified for our viewers?
A sell in Bharti, stop loss 319.50, target 309. A sell in Bajaj Auto, stop loss 1987, target 1910. A sell in BHEL, stop loss 204, target 192. And a buy in Jubilant Food, stop loss 1163, target 1232.
Sandeep Pagle, thank you for those trading ideas. Tankar, do you think Tata Motors currently is in a spot of bother? They've lost market share in the domestic passenger car market. They've lost market share in the CV market where they are a dominant player. And JLR last night has reported that China seems to be slowing down.
Yes, there is worry on the domestic side of things, definitely. But what we are more concerned about is, given this, that about 75 to 78% of the valuation for Tata Motors comes in from its JLR segment, we are more worried about what's happening in China. We're still watchful of overall growth pointing out there. Essentially, competitors have done fairly well. Brilliance's numbers were fairly good, in China. So we are actually watchful of what's happening with China numbers for JLR. Be that as it may, overall, we expect the stock to do well, frankly, because there are launches coming in on stream, and overall, the numbers for JLR are expected to be okay. I mean, we will see the wholesale numbers coming in a few days, and that should give us more comfort. But I take your point. On the domestic side, the CV cycle is not likely to improve anytime soon, and that hurts not just Tata Motors, also Ashok Leyland is one stock that we don't like there. And yes, on the car segment, everybody is feeling the pain, frankly.
Morgan Stanley also is making a point that the reason why JLR numbers for Feb were not strong is because of the Chinese New Year, and China was shut for more than 10 days in the month of Feb on account of the Chinese New Year. As a result, the China sales has plummeted, and Morgan Stanley believes that in coming months, the Chinese market is likely to recover. Tankar, what are your thoughts on DLF? The stock is up 25% this year. It hit a new 52-week high yesterday at a time when the mood or the outlook towards real estate stocks in the real estate sector is negative. What explains the underlying strength in DLF? What is the fundamental story or thesis here?
See, we've been pushing DLF since November when it was around 180 levels. So at this point, I think it's better to take some money off the table given the macro concerns. What actually made us positive on the stock was a string of events which were largely company specific, which were essentially then aided by a macro risk on that we saw coming in around October, November, and which continued all the way until December. Specifically for the company, the debt levels are likely to come down. There was a tangible debt restructuring plan that the management actually put out. So overall debt of around 25,000 crores is expected to come down to, I think, 17,000 crores over the next 2 years. The company was finally able to, find a buyer for Aman Resorts. And thirdly, the wind power business was also sort of, they were able to get a buyer there. And the company has also been guiding that execution would henceforth be much better, and debt restructuring would be something on their radar going forward also, which essentially gave the market and us cause for cheer, and that's why we had upgraded the stock to buy when it was at 180 levels. At this point, given our caution on the macro and given the phenomenal returns that the stock has given, we will not advise entry into the stock, and in fact, some profit booking could happen.
Tankar, what's the view on IT now? Considering it's even outperformed the index, are all positives now in the IT pack, or is there still some valuation catch up in any of the names?
See, I think stock like TCS at a 52-week high, one would not be pushing now, but we still like Satyam. Our target price is 140. I think growth drivers are still in place. there is meaningful upside even there. Overall, from a top-down perspective, IT sector has done fairly well. We upgraded the sector from underweight to neutral in our model portfolio earlier this year, and I think with about 25-28% overall returns, one would not expect outperformance from the IT sector going forward, particularly before the fourth quarter numbers and the guidance comes in. But we would not be selling IT at this point from a sector perspective, given the caution on macro. Our focus now is increasingly moving towards a more global portfolio, a more dollar-rated portfolio from domestics, and IT forms a key segment in that particular stance.
Tirthankar, what's the view now on banks, and how are you approaching the sector, both private as well as PSU lot, in light of what your expectation from the RBI is on the 19th? A big question mark there. And how do you think equities would pan out?
See, I think, again, let's go back to November, December. What happened essentially was that the market was fairly expecting the central bank to cut rates. That really did pan out. PSU banks did fairly well. But after that, you've seen GDP numbers come in much more sober. We did not see big bang reforms at all coming from the budget. On the other side, where the budget did not disappoint was, you did not have any fiscal arithmetic going wrong. So you have a pretty much stable outlook from the fiscal side right now, and which translates to the net borrowing numbers. And on GDP, unfortunately, asset quality issues are likely to remain an overhang for the banking sector. The question there is how much of it is in the price. What we do know for sure is that the central bank is going to cut rates this year. Excuse me. Therefore, the overall cost of funds in the economy are going to come down, and which is why we do have a positive stance on financials. But what we have been doing is, overall, we've been cutting off, and we would not be pushing PSU banks as a space right now. And the shift is, if you want to do an intra-sector shift, it's obviously from PSU to private. But let's not forget that going forward in FY14, because street numbers on growth are likely to be panned down, one would see urban consumption actually taking a hit, and that's why we'll be cautious even on private banks going forward over the next 6 to 9 months period.
In the short term though, give us your top 2 ideas from the banking pack.
I think ICICI Bank is one stock that we like in this space, and the other one is of course SBI. The rate cut is going to come in, so we will see SBI moving up.
Okay, Tirthankar, hold on to that thought. Let's bring in Deepak Mohini quickly, or actually let's tell you about what he's recommending this Wednesday morning. He's got a buy call on Union Bank, recommends shorting Havells. NTPC as well is a sell idea for him with a target of 144 and a stop recommended at 149. Quick break.